Have you ever stopped to wonder, even for a moment, who really controls the money, the flow of capital, the very lifeblood of our economy? Who decides what ends up in your wallet and how much purchasing power it actually holds? There's an institution, a central authority so powerful, so influential it can create trillions of dollars, seemingly at will, conjuring wealth out of thin air with the stroke of a key, and directly influence every single financial decision you make, from the smallest to the largest. And yet, despite its pervasive influence, most people, the vast majority, have absolutely no idea how it works, what its true purpose is, or who it truly serves. This is the Federal Reserve, often simply called the Fed. It's arguably the most influential and perhaps the least understood financial entity on the planet, a silent giant shaping the world's economy. With decisions that ripple outwards, creating a domino effect, through every corner of our economy, affecting businesses, markets, and individuals alike, from the price of your morning coffee to the security of your life savings and retirement accounts. The Fed is a strange hybrid, a unique and often perplexing institution, not quite government-controlled and certainly not entirely private, but holding the keys, the ultimate power, to the entire U.S. economy. Its stated mission? To keep prices stable, preventing runaway inflation or deflation, maximize employment, ensuring as many people as possible have access to jobs, and ensure the banking system remains stable, preventing widespread financial panic and collapse. But how it actually does this, the methods it employs, is where things get incredibly complicated, a tangled web of financial instruments and policies, and frankly a little scary once you start to understand the implications. Think of the Fed as the ultimate puppet master, the unseen hand guiding the economy. When it pulls a string, adjusts a lever, interest rates move, markets fluctuate, and the entire economy reacts, often in unpredictable ways. In this deep dive, this exploration into the heart of the financial system, we'll pull back the curtain, revealing the inner workings, on the Fed's secret origins, its controversial beginnings, how it manipulates money, controls the money supply, and who really pulls the strings, who truly benefits from its power. By the end of this journey, you'll see exactly how this powerful entity, this often shadowy institution, reaches into your life, influencing your decisions, impacting your future every single day. To understand the Fed, the complexities of its structure, and its profound impact on our lives, we have to go back, peel back the layers of time, to a time of financial chaos, a period marked by instability and uncertainty, before 1913, before the establishment of a system designed to bring order, when the U.S. had no central bank, no unified monetary authority. Banks issued their own currencies, a patchwork of financial instruments, and panics were common, erupting with alarming frequency. The Panic of 1907, a particularly severe episode, nearly destroyed the economy, pushing it to the brink of total collapse, saved only by J.P. Morgan's, the powerful financier, personal intervention, a testament to his influence. It was clear, painfully clear, America needed a stable financial system, a bulwark against future crises. In 1910, Senator Nelson Aldrich, a key figure in the political landscape, and a handful of the nation's most influential, most powerful bankers, the architects of American finance, met in secret on Jekyll Island, Georgia, a secluded location far from public scrutiny. They used fake names, cloaking their identities in secrecy, and told their families, weaving a web of deception, they were going duck hunting, a convenient alibi for their clandestine gathering. For a week, they drafted a plan, meticulously crafting a new financial order for a new central bank, a radical departure from the existing system, one that could act, with the authority and resources as a lender of last resort, providing crucial support during times of crisis, provide an elastic currency, adjusting the money supply to meet the needs of the economy, and supervise the nation's banks, ensuring stability and preventing reckless behavior. Their plan became the blueprint, the foundation upon which the modern financial system would be built, for the Federal Reserve Act, the landmark legislation that reshaped American finance. After years of debate, heated discussions, and political maneuvering, President Woodrow Wilson signed it into law, forever altering the course of American economic history, on December 23, 1913, a date that would live in infamy for some, just before Christmas, a time of year associated with peace and goodwill, when many in Congress had left town, perhaps unaware of the significance of the vote they had cast. The act created the Federal Reserve System, a complex and powerful institution, 12 regional reserve banks, spread across the country, overseen by a board of governors, appointed by the president in Washington, D.C., the heart of American political power. It was a monumental shift, a paradigm shift in the way America managed its money, creating the institution, the central bank, that would define modern finance, shaping the global economic landscape, and control the fate of the US dollar, the world's reserve currency. The Fed was born out of secrecy, conceived in the shadows, designed by bankers, the very individuals it was meant to regulate, but sold as protection for the public, a promise of stability and security. Its hybrid structure, a blend of public and private interests, public mission, private influence, a delicate balance, remains controversial to this day, sparking endless debate and scrutiny. And it all started, the entire saga, with a secret meeting, a clandestine gathering, on a remote island far from the prying eyes of the public. When people say the Fed prints money, they imagine printing presses and stacks of cash, but the real power is digital. The Bureau of Engraving and Printing handles physical bills, but the Fed creates most money with a few keystrokes. This is called quantitative easing, or QE. The Fed buys assets, mainly government bonds from commercial banks, paying with newly created digital dollars. Suddenly, banks have more cash to lend, which should spur economic activity. This increases the money supply without printing a single bill. The goal: lower long-term interest rates, making borrowing cheaper for everyone. But there's a risk. Too much money can cause inflation, eroding your savings. The Fed must balance stimulating growth with keeping inflation in check. It's a delicate act, pouring just enough gasoline on the fire to keep the economy burning, but not explode. The Fed's digital money machine is powerful, but not without consequences. The Fed has three main tools to steer the economy. First, the federal funds rate. The interest banks charge each other for overnight loans. It's the foundation for all other interest rates. The Fed influences this rate through open market operations. Buying securities injects money and lowers rates. Selling pulls money out and raises rates. Second, the discount rate, the rate banks pay to borrow directly from the Fed. It's a backstop for banks in trouble. Third, the reserve requirement, the percentage of deposits banks must keep on hand. Lowering it frees up money to lend, raising it tightens the money supply. In 2020, the Fed set the reserve requirement to 0, making it a less active tool. These levers let the Fed control borrowing costs, credit availability, and ultimately, the pace of the economy. Every move affects your loans, savings, and job prospects. The Fed's toolkit may seem technical, but its impact is deeply personal. Understanding these tools is key to understanding your own financial world. Who owns the Federal Reserve? It's not a simple answer. The Fed isn't a government agency, but it's not fully private either. Member banks like JP Morgan and Bank of America are required to buy stock in their regional Fed banks. But this stock can't be sold or traded, and it pays a fixed dividend. Member banks don't control monetary policy. That's up to the Board of Governors, appointed by the President and confirmed by the Senate. The real authority lies with the 7-member board in Washington, D.C., serving long terms to insulate them from politics. The Fed's profits? After expenses and dividends, most are returned to the U.S. Treasury. So while the Fed's structure is private in some ways, its profits largely serve the public. This hybrid design public mission, private framework fuels endless debate and suspicion. But the reality is the Fed is independent but not unaccountable. Its unique structure is meant to balance stability, independence, and public interest. With so much power and secrecy, the Fed is a magnet for conspiracy theories. Its secretive founding on Jekyll Island only adds fuel to the fire. Some believe the Fed was created by elite bankers to control the nation's wealth, or that it engineers booms and busts to benefit insiders. Others claim it's run by foreign interests or powerful families, aiming for a one-world government. Mainstream economists dismiss these as myths, but the Fed's lack of transparency keeps suspicions alive. Critics argue that an unelected body with such power is undemocratic and too close to Wall Street. The truth? The Fed is powerful, complex, and sometimes opaque, leaving plenty of room for both legitimate debate and wild speculation. In the shadows between fact and fiction, the Fed's mystique endures. The Fed is full of surprises. It has its own armed police force to protect its buildings and assets, including one of the world's largest gold vaults, deep beneath the New York Fed. The president can't fire the Fed chair over policy disagreements, governors serve fixed terms and can only be removed for cause. The Fed employs hundreds of PhD economists producing influential research and economic data used worldwide. Since its creation, The US dollar has lost over 96% of its purchasing power. A dollar in 1913 is worth about 4 cents today. The Fed's target isn't zero inflation, but a steady 2% per year, to encourage spending and investment. The Fed is both a nerve center for economic data and a force shaping the value of your money. Its influence is everywhere, even if you never see it. So, after all this discussion about the Federal Reserve, what does it all really mean for you, the average person? How does this powerful institution impact your day-to-day life? The Fed's decisions directly hit your wallet. They influence your job prospects, and ultimately, they play a significant role in shaping your future financial well-being. When the Fed decides to raise interest rates, a ripple effect is set in motion. Suddenly, borrowing money gets more expensive across the board. Credit cards, mortgages for homes, and even car loans all become more costly. The impact on consumers is immediate and tangible. Conversely, when it lowers rates, aiming to stimulate economic activity, borrowing becomes cheaper and more accessible. However, savers often find themselves earning less on their savings accounts, a less desirable outcome. The Fed's actions inevitably create a tug-of-war dynamic between those who are borrowers and those who are primarily savers. And your individual financial situation largely determines which side of that tug-of-war you're on. Beyond interest rates, the Fed also significantly shapes the job market. Lower interest rates can stimulate hiring and lead to wage increases, boosting overall employment. But raising rates, a tool often used to combat inflation, can unfortunately slow down the economy, potentially leading to job losses and economic hardship for some. The Fed's ongoing battle against inflation, while necessary for long-term stability, often comes with very real and sometimes painful human consequences. So, what's the biggest myth surrounding the Federal Reserve? It's the misconception that the Fed is a distant, detached, and ultimately irrelevant institution. But in reality, it's more like an invisible hand, constantly at work, subtly but powerfully guiding your financial life and the economic landscape around you. Therefore, understanding the Fed and its operations is an absolutely essential component of financial literacy for everyone. By staying informed and knowing what the Fed is doing and why, you can empower yourself to make smarter, more informed financial decisions, whether it's locking in a mortgage at the right time, strategically paying down debt to minimize interest payments, or simply planning more effectively for your future financial security. In a world that is so profoundly shaped by the actions of the Fed, knowledge truly is your best and most powerful financial weapon.